The most profitable thing a day trader can do is nothing. And it's also the hardest. Look at this. You're watching a stock crash from $100 to $60 in seconds. Every instinct screams at you to do something. Save what you can. But here's where the pros are different. They had a risk plan, the rules for how much they'll lose before they walk away, before they ever bought in. Without that plan, you're one bad drop away from losing everything. Ready to learn the rule that separates winners from everyone else? Why does the same trader who made $5,000 last week refuse to take this trade? It's because they understand something fundamental. The balance between risk and reward, the R multiple. Imagine you're standing at the edge of a cliff looking at a rope swing. On the other side is a bag of cash. The swing is your trade and the bag is your potential profit. But the fall? That's your risk. Now think about this. Every trade you make is like deciding whether to take that swing. If the rope is strong and the swing is short, the risk is low, just like when a trade has a favorable R multiple. But if the rope looks frayed and the swing spans a chasm, the risk is high. That's what happens when you ignore the R multiple. Backing this up in trading terms, the R multiple helps you calculate what you're risking versus what you can gain. It's the ratio of the potential reward to the risk taken. If you're risking $10 to make $30, your R multiple is 3 to 1. This means for every dollar you risk, you have the potential to earn 3. Without understanding this concept, you might take trades where you're risking too much for too little reward. It's like swinging on that rope with no idea how wide the gap is. But what separates successful traders from the rest? It's knowing which swings to take. They won't risk it unless the potential reward justifies the risk, ensuring their R multiple is favorable. As we move forward, keep this in mind. Every trade should be a calculated swing, where the risk is considered and the reward potential justifies stepping off the edge. This understanding of risk versus reward is the foundation. Ready to see how this plays out in real trading scenarios? That's coming up next. You're staring at a candlestick chart, and you're considering a trade. The stock is sitting at $50, and you believe it has the potential to rise to $60. But there's also a chance it could drop to $45. How do you decide if this trade is worth taking? This is where the R multiple comes into play. The R multiple is a way to measure the risk versus reward of a trade. It's calculated by dividing the potential reward by the potential risk. In this example, your risk is $5 if the stock drops from $50 to $45. And your potential reward is $10 if it rises to $60. This gives you an R multiple of 2 to 1, meaning you're risking $1 to potentially earn 2. Now let's visualize this on a chart. You place your stop loss, a preset price where you automatically get out of a losing trade, at $45, ensuring that your maximum loss is $5 per share. Your target is $60, aiming for a $10 gain. The R multiple helps you see that for every dollar you're willing to risk, there's a potential to gain 2. This is a favorable setup. Applying the R multiple to your trading decisions is like having a strategy guide. It forces you to quantify your trades before you commit. Instead of making emotional decisions based on fear or greed, you're using a structured approach that focuses on maximizing potential gains while minimizing risks. Remember, not every trade will hit its target, but by consistently applying the R multiple, you position yourself to come out ahead over time. So next time you're about to take a trade, pause and ask, what's my R multiple here? This simple question transforms trading from a gamble into a calculated strategy. Still with me? Here's the part that breaks most traders. Ignoring your R multiple can cost you more than you realize. Consider this scenario. You take 2 trades. In the first, you risk $100 to potentially make $200. In the second, you risk the same $100, but your potential profit is only $50. Which one would you pick? This isn't just about the money you can make. It's about how much you're risking to get there. The R multiple lets you measure that relationship. Skip it and you're flying blind. You're taking trades without really knowing how they'll hit your account. Here's an example. A trader named Alex jumps into a trending stock. He's read about the R multiple, but thinks it's too much hassle to apply. No clear plan. He risks $300 on a trade that could pay out $200 max. On paper, sounds like a win. But dig deeper. By skipping the R multiple, Alex set himself up for a scenario where even his winners don't cover his risk. The R multiple compares what you're willing to lose against what you expect to gain. In Alex's case, a 1 to 0.67 ratio means for every dollar he risks, he only gets 67 cents back. Over time, decisions like this stack up, leading to serious drawdowns, the peak to valley loss on your account during a losing streak. Now flip it. Picture a disciplined trader who only takes trades with at least a 1 to 2 risk-reward ratio. Even if only half their trades win, they still come out ahead. Their winners far outweigh their losers. That's the power of the R multiple. A string of losses won't wreck your bankroll. But here's where it gets weird. Plenty of traders know they should use it, yet they skip it. Feels like extra work, or they're too locked in on the profit side. The cost stays hidden until it's too late. It shows up as a shrinking account and growing frustration. So next time you're about to click buy, ask yourself, do you know your R multiple? Are you risking $1 to make $2, $3, or more? Or are you walking into a costly mistake? Spotting this could be the difference between an account that grows steadily and one stuck in recovery mode. Imagine you're sitting at your desk with a trading journal open in front of you. It's filled with charts, numbers, and notes from previous trades. Today, you're analyzing a particular trade on XYZ stock that didn't go as planned. You see a $500 loss staring back at you. And it all boils down to one decision: ignoring the R multiple. Now let's step back. What exactly is this R multiple? It's a simple yet powerful concept in trading that measures your risk versus your potential reward. Think of it like this. For every dollar you risk, how many dollars are you aiming to gain? The R multiple helps you quantify this relationship. In this trade, let's say you risk $250, hoping to make $500. That gives you a risk-reward ratio of 1 to 2, a positive R multiple. But here's the kicker. You didn't set a stop loss. Instead, you held on, hoping the trade would turn around. As the price of XYZ stock dropped further, your potential loss grew. By not respecting your R multiple, your trade spiraled into a $500 loss. This scenario highlights a critical lesson. The R multiple isn't just a number, it's a guidepost. Without it, you risk letting emotions dictate your decisions, leading to bigger losses. This is why seasoned traders always have an exit plan. They set specific stop losses to keep their losses in check and ensure their trades remain within an acceptable R multiple. So what's the takeaway here? Before entering any trade, calculate your R multiple. Know exactly how much you're willing to risk and what you stand to gain. If your potential reward doesn't sufficiently outweigh your risk, it might not be worth the trade. To bring this to life, let's say you're considering another trade. This time you've learned your lesson. Before jumping in, you determine your entry and exit points. You decide to risk $200 with a target gain of $600. That's a 1 to 3 risk-reward ratio. Now you're not just hoping for a favorable outcome, you're trading with a plan. By applying the R multiple consistently, you transform your trading from a game of chance into a strategic endeavor. This discipline not only protects your capital, but also positions you for long-term success. And it's this disciplined approach that separates the traders who thrive from those who merely survive. So next time you face a trading decision, remember the power of the R multiple. Let it guide your risk management strategy and keep you on the path to steady growth. Because in the world of trading, managing your risk effectively is the key to unlocking your potential. Picture a scale in perfect balance. On one side, risk. On the other, reward. That's the heart of the R multiple. The R multiple is a straightforward tool. It measures the reward you expect for every unit of risk you take. Risk $100, aim to make $200, and your R multiple is 2. That simple ratio tells you if a trade is worth taking. To use it well, follow 3 rules. First, define your risk before you enter a trade. Know exactly where your stop loss will sit. Second, make sure the potential reward justifies the risk. A 2-to-1 ratio is a solid starting point. Third, only take trades that meet these numbers. That keeps you disciplined. If this is useful, subscribe. We cover this psychology twice a week. Sticking to the R multiple protects you from impulsive decisions. It lines your trades up with a clear, objective framework. Trading stops feeling like a gamble and starts feeling like a plan. Next time you face a decision, picture that scale. Weigh your risk against your reward. Let the R multiple guide you. The goal isn't just winning one trade. It's building a method that moves you closer to your financial goals. So which side of the scale will you let tip in your favor? Ready to take control of your trading journey? Join PJ Trades today and gain access to tailored strategies, insights, and a community of like-minded traders. Whether you're new to trading or looking to refine your skills, PJ Trades can help you tip the scale in your favor. Start building a disciplined approach with the guidance you need. Visit pjtrades.com and begin your path to smarter trading decisions. Your financial future deserves a plan. Make it happen.